Best and safe mutual fund investing strategy. Regular mutual fund investing in stocks offers a fairly safe and efficient way to earn a good return on your investment over the long term, 10 years or more. Regular fund investing means investing a certain amount of money in a fund at regular intervals, so that when the fund price is low, more shares are invested and vice versa. Thus, even if the price of the fund years later, at the time of sale, is even lower than at the beginning of the investment, the return may have been high. Of course, it is always more profitable to buy a large amount at a low and sell at the peak, but it is unlikely that this will often be the case in the long term, as it is a gamble to anticipate peaks and troughs. It is impossible to say which fund will perform best over the next 10 years, so you should at least choose one or even several that has little or no expenses. These funds are called index funds, which track a specific stock market index. The low or no expenses are due to the fact that the portfolio manager of the index fund apparently does not do much buying or selling in terms of the holdings, shares in companies, of the fund. Such funds usually always invest in the largest and most stable companies. The S&P 500 index fund tracks the US S&P 500 stock market index. In general, you should choose a fund that invests mainly in North America and Europe, and perhaps also in Asia, with a wide range of sectors represented. The calculation and graph next explains the idea of regular fund investing in low-cost or no-cost index funds. If an investor had invested a certain amount of money at the beginning in a fund, whose price had gone like this, he would have lost 20% of the money he had invested. If, on the other hand, he had invested the same amount of money, at regular intervals in the same fund, he would have already made a profit of more than 10%. In other words, by buying the same amount when prices are low, you get more shares and vice versa. Of course, if you owned an omniscient crystal ball, and knew that the stock market would go up every year for the next 5 to 10 years in a row, then of course you would immediately put all your extra money into the stock market. The main advantage of regular fund investing over a lump sum investment is the reduction of risk over time. The fact is that no one knows whether stock market prices in general will rise or fall over the next year. The value of a fund may have risen 30% in the last 6 months, but in the next 6 months it may fall by the same amount. A regular fund investor, on the other hand, has bought a fund for a small amount first, bought more for the same amount after a certain period of time, and so on. There is no need for much of a rise in basis when investing in this way has already yielded a profit. Spreading the total amount invested over a long period of time is also a big advantage. If a family has an extra $10,000 a year that should not be wasted on anything, it is wise to invest this amount in, for example, an equity fund of $833 per month and do the same in future years. In 10 years, the $100,000 has been invested, but the profit is likely to be the same, calculated at a moderate 8 to 9% annual return. So this $100,000 investment has yielded the same amount of money. It must be remembered that this sum of $100,000 would not have been possible to invest, without taking on debt, in the first year of the investment. It is true that the biggest gains are made by taking small profits and doing this often enough. Or, alternatively, by picking a stock whose price rises by hundreds or thousands of %. These things just don't work for very many people and require close monitoring of stock movements and expertise, as well as good luck. Regular mutual fund investing, on the other hand, requires little or no knowledge of the market or close observation of the market. It is impossible to say which funds will be at the top of the yield curve in the next 10 years. Historically, major price falls and stock market crashes have lasted from a few months to 2 or 3 years. If you are interested, you can find more information in the description of this video. Thank you for watching.